Hi, everyone. Thank you so much for being patient with us as we start our live event today. Today, we are talking with our tax team, and this is our Cannabis Tax Talk Roundtable. So thank you, everyone, for joining us. Real quick, I do want to read a quick disclaimer. Before we get started, I do have to let everyone know that the information contained in this presentation is meant for guidance purposes only and not as professional, legal, or tax advice. Further, it does not give personalized legal, tax, investment, or any business advice in general. So again, thank you everyone for being here. First, I'd like to thank all of you for joining us, and we are thrilled to have you here to learn more about the taxes, and we're so glad you tuned in to hear from our team members. Today, we are joined by our very own GreenGrowth tax experts and team members specializing in the cannabis industry. You can find links to their bios and contact information in the description of this video, so make sure to check everyone out. Panelists, thank you for joining us today. We're so honored to have each of you here today and very much appreciate you taking time to share your experience, advice, and expertise at our Cannabis Tax Talk Roundtable. Today, we will cover a series of group discussions. We'll spend some time speaking with Jessica, discussing ERC credits, bonus depreciation, and our new tax service line. That's very exciting. Then we'll transition into a conversation with Natalie about the importance of 1099 records, property taxes, and the $80 billion IRS funding and what that means for cannabis operators. We'll also review extension deadlines and FAQs with John before we head into the Q&A session. So now before we get started with the discussions, I want to read you a little bit of background about each of our presenters. Our first panelist is Jessica Thompson. Jessica has a unique gift of making tax time easier and understanding and make it a lot less stressful for you. She holds a master's degree in accounting, as well as both a CPA and a CFP certification. Holding both certifications makes for a unique skill set in all aspects of tax and finances for individuals and business owners. She's excited to help relieve your tax stressors and grow your business. Our second panelist is Natalie Rasmussen. Natalie is an enrolled agent with 20 plus years of experience in the tax accounting field. Her experience includes all areas of taxation, accounting, and planning. With an enrolled agent certification, Natalie is federally authorized tax practitioner who has technical expertise in the field of taxation and is empowered by the U.S. Department of the Treasury to represent taxpayers before all administrative levels of the IRS for audits, collections, and appeals. Our third panelist is John Lawson. John began with GreenGrowth CPAs as our client success leader. He quickly proved himself as an amazing asset to our clients and our team. We're excited we promoted John to client success manager here recently, and we're just super excited to watch his continued growth in the cannabis tax and accounting space. John is a lot of times your first contact with our firm, and we feel really good that you're in good hands as you become familiar with our services. John graduated with a BS in Business Administration, emphasis in marketing, while being a student athlete for the men's soccer team at Chapman University. And he also earned his master's degree in coaching and athletic administration from Concordia University, Irvine. He's had 15 years experience on the client success side, client service side, and we're just super, super excited to have him on our team. All right, so let's go ahead and jump right into it. Our first discussion is with Jessica. Thank you, Jessica, for joining us today. Now, the first question is, we've been hearing that cannabis businesses are eligible for the ERC credit. Is that true? And what are the income tax consequences to this?
Yes. First, I just want to say I'm very excited to be here. This is really fun that we're all together doing this today. But to answer the question, yes, cannabis businesses are eligible for the ERC credit. That's a common question we get because, I mean, as everyone in the industry knows, unrightfully so, cannabis is excluded from a lot of the tax credits that other businesses have, but it's very exciting that this is one that they are eligible for. So to answer, yes, they are eligible for it, but the tax consequences is a big thing that a lot of people are unfamiliar with, specifically with regards to the two choices that you have when you get this credit. So a lot of people, first of all, don't don't understand or realize that there are two choices you have with receiving the credit. And secondly, a lot of people are unfamiliar with the tax consequences of each one. So when you apply for the credit, when you receive it, you have two options. You can receive the credit as a carry forward credit to offset and reduce future payroll tax liabilities. So this would mean when you file your quarterly payroll tax, you just wouldn't have to submit the necessary like withholding payments that you've been collecting through payroll through that quarter, because you're offsetting that payment that you would normally pay with this credit that you have carrying forward. The downside to that is there is some talk about this being cause for if the IRS were to come back and audit you for this credit and they were to decide that actually you were not eligible for the credit, then you could be hit with the trust fund recovery penalty. It's called a TFRP, and that penalty is no joke. It's once you're assessed with it, it's virtually impossible to get it waived. The IRS is very serious about that penalty, and what that penalty is that you were withholding the correct payroll taxes from your employees, but you failed to submit that. So we were recently talking to an auditor about this credit, and he warned us about the potential of that. We've actually never seen anybody hit with it, but since we were told about it, we wanted to make sure that everyone is aware of that as something that the IRS might be able to come back later and assess that penalty if they deem that you're ineligible for the credit. So with that risk brings me to what your second option is for collecting the ERC credit. So the option one, where you have to carry forward to the future payroll tax liability, that's the option that most people are familiar with and the most frequently seen option we've seen people take. But the second option is that you can file a request. You have to file a specific form called Form 7200, and that's requesting an advancement of that credit. So it's no longer a carry forward. It's actually requesting that the IRS mail you a check to receive the credit. The tax consequences of this is that you have to go back and amend your prior year return. So these ERC credits are typically hitting either tax year 2020 or tax year 2021 or both, depending on what your eligibility is. And if you've already filed 2020 and 2021, which most people have at this point in time, if you receive a credit for either one of those years, the IRS requires that you go back and amend those returns, which isn't a big deal. I mean, it's easy enough to do. It's just kind of a little bit of a hassle. And also, typically, you're going to have to pay your accountant a little bit to amend the return. The benefit of this option is that it doesn't appear that the IRS could come back and issue that TFRP penalty because you are, throughout the entire history of you filing your payroll tax returns, are submitting that withholding. And instead, the IRS has just issued you a refund. You didn't actually stop yourself from submitting a withholding payment that you were supposed to. So it seems like there's a little bit less risk in option two. However, there's a little bit more work on your end because then you have to go back and amend those returns. And these tax consequences I talked about are from an IRS standpoint. Each state is a little bit different. So when you're looking at this, you would want to look at your unique state situation. But an example of, I mean, a lot of our clients are in California, so I'll use California as an example. California doesn't require that you amend the return to adjust if you receive that refund check because they're allowing the full deductibility of the payroll tax liability, even if you receive the ERC credit. But every state is different on if they're following the IRS or if they have their own rules. So we would want to make sure that you look at your state rules before deciding if you're going to amend your state return or not.
Awesome. Thank you so much, Jessica. Definitely would want anybody with questions to reach out to us for that, especially if they have specific state questions. So thank you for breaking that down. Now, is bonus depreciation still an option?
Yes, it is. So there's a little bit of a misconception around bonus depreciation. Is one, a lot of people think that 2022 is the last year for bonus depreciation, but the reality is that 2022 is the last year for 100% bonus depreciation. And then starting in 2023 all the way through 2026, there's going to be a gradual phase out. So a couple of things about bonus depreciation. One, for normal day-to-day businesses, this is not seen as any sort of type of aggressive tax approach by any means. It's a very common practice. For cannabis entities, some people might try to, I guess, steer you away from bonus depreciation or say that it's an aggressive deduction. Personally, I don't believe that's the case. We've successfully been able to utilize bonus depreciation for our cannabis clients. We have actually even survived an audit with our stance. The key is making sure that you have the appropriate documentation and support based on your allocations and why that asset would be a deductible and depreciable expense for a cannabis entity in their cost of goods sold. So that's the one little caveat I have towards bonus depreciation. But what the basics of bonus depreciation is it allows you to take a fixed asset that you would normally have to depreciate over the life of the asset, and it allows you to deduct the expense 100% in the first year by electing bonus depreciation. And that's how it's been since 2018, and that's how it still is for 2022. But starting in 2023, it's going to phase out. And what I mean by that is instead of allowing you to depreciate 100% in the first year, that depreciation percentage is going to be reduced. So in 2023, it's going to go down to 80% is depreciable in the first year, and the remaining 20% you're going to have to depreciate over the asset, the life of the asset. 2024, it's going to go down to 60%. 2025, it'll be 40. 2026, it'll be 20. And then in 2027 is when there will be 0% for bonus depreciation. That is a little ways down the road, as everyone knows, and tax law is constantly changing. So at any point in time, they could extend it, or they could completely rewrite the bonus depreciation rules like they did back in 2018. But that's how it is currently.
Awesome. Thank you so much. Definitely something to watch going forward. So thank you for that. Now, can you tell us about the pass-through entity tax in California? When would this be beneficial?
Yeah, so the pass-through entity tax started in California in 2021. And at this point forward, it's applicable to, if you applied in 2021 all the way through 2025. You have to make the election every year on the tax return. But what is very important is that starting in 2022, for the remainder of what this is currently written in law through the 2025, in order to make the election on your tax return, you must have planned for it and made an accurate estimated tax payment by June 15th of the current year. Otherwise, you're not eligible for that. So right now we're in tax year 2022. You'll be filing this year's taxes in 2023. But if you wanted to make the election for 2022, you had to have done so, or at least made your payment by June 15th of 2022. So at this point, if the payment hasn't been made, it's not an opportunity for 2022, but it is an opportunity for next year. It's not if you don't elect it this year, you can never elect it again. You can elect it next year. So it's just something very important to keep in mind for planning purposes, is you have to have planned for this and calculated an accurate payment, because if your payment is too low, if you don't make a large enough payment, you're disqualified from electing it as well. So you have to have some serious planning. You have to have your ducks in a row, so to speak, with all your finances, and your books need to be up to date and accurate so you can make the appropriate payment by June 15th. And the people that will benefit from this is only people that operate their business as a pass-through entity. And a pass-through entity is a partnership or an S corporation. And the reason that this has kind of become a thing is because of all the tax law changes back in 2018, specifically when they have limited the amount of state income taxes individuals can deduct. A lot of individuals exceed the cap of $10,000, so they're no longer getting a benefit from that. And what this pass-through entity credit is essentially the pass-through entity, so the partnership or the S Corp, is paying a tax payment to the state on behalf of the individual owner. And so then that payment made passes through to the individual, so they get credit on their state tax return for that payment that's made. The one caveat to that as well is it's not a refundable credit. So if the business pays too much on the individual's behalf, the individual is not going to get this huge refund for it. What happens is they get to carry it forward to future years. And this pass-through entity credit is a thing in multiple states, not just California. But again, we're focusing on California because most people joining us today are from California. And also California is one of the newest ones. So every state's a little bit different on how they handle that excess payment, if there is one. But in California, they get to carry it forward for 5 years. So if you didn't use it all this year, you can use it to offset future state tax liability within the next 5 years.
Awesome. Great information. Thank you so much, Jessica. Now, one thing I wanted to do is give you a chance to let the viewers know about the exciting new tax service that we're rolling out at GreenGrowth. So I'd love to give you a minute to run that through.
Yeah, so I am very excited. We have a new tax service. It's been highly requested by our clients, so very excited to be officially rolling this out. It's called the Quarterly Tax Review, and it's actually very fitting for what we just talked about with all of the details with the pass-through entity credit. This will help you to, like I mentioned, have your ducks in a row when it comes to your finances and books so that we could do planning items like that. So every quarter, we would review your entity's financials and we would let you know of anything that looks off. So if there's anything that looks incorrect, or when we compare to the previous quarter, if anything looks like it changed drastically, like you have a 200% jump in a certain expense, we'll flag that for you and let you know, like, here's some red flags we saw, here's some things that need to be fixed, and we'll give you some pointers on how to get those cleaned up in your books. So that way you're not just like going in blind, and you have the education to fix that going forward. And then once the books are cleaned up, we each quarter will do a tax projection for you. So what we'll say is like, hey, with the current state of your business, if nothing else changes, here's what your tax liability would look like when we go to file your tax return next year. And then not only do we tell you what your tax liability looks like, but we will also calculate an estimated payment that you should make to reduce interest, penalties, and avoid having that huge, scary tax bill when we file your tax return. So you spend the whole year fully aware and prepared for what your tax liability could be. You've planned ahead so you can avoid interest and penalties. And then on top of that, we also give you some pointers and some strategies for how to plan the rest of the year to reduce that burden. So if you don't want to do any of the ideas, we've at least given you all the tools to make the payments and avoid interest and penalties. But on top of it, we're also giving you ideas on, hey, you know, if you don't like how much that is, right? If you owe a large amount, nobody wants to pay that if they don't have to. So we give you some strategies and some planning tips on what you could do before the end of the year to reduce that. In addition, anyone that's on this tax review service receives priority during busy season around the deadlines, and also has monthly access to our staff accountants for questions and things that would come up month to month.
Awesome. Thank you so much, Jessica. I was super excited for the new service line, but thank you so much for all of your information. Definitely beneficial as we head into another deadline here shortly. So thank you so much for your input.
Thanks, Natalie.
Thank you. All right, next we are going to speak with Natalie. Natalie, thank you so much for joining us today.
Thank you for having me.
Yeah, we have some popular topics to go over today, including the $80 billion IRS funding. So let's get right into it. Now, Natalie, can you tell us about AB 195? Can you tell our viewers more about how that could impact them?
Yes, and this is, again, kind of doubling up on Jessica. This is very California-centric. So this is Assembly Bill 195, which was actually finally signed by the governor last month. It had been sitting on his desk for a very, very long time. And a lot of things that a lot of cannabis operators have lobbied for have finally come to fruition to help the disparity with, you know, legal cannabis operators with illegal cannabis operators. So basically what this does, it eliminated that cannabis cultivation tax. And currently that cannabis cultivation tax was $168 a pound, which was assessed to cultivators. But the distributors and the manufacturers were the ones responsible for getting that tax from the cultivators and then turning it over to the state. It was very, very complex, very hard to keep track of. So that has now been eliminated as of June 30th, 2022. And in addition to that, it caps the excise tax, and the excise tax is what is actually charged to the end consumer, the customer, at 15% for at least the next 3 years. Now, because they got rid of that cultivation tax, that excise tax will more than likely go up in 2025, 26, I think, but they're looking to see if they can cap that even more. But like I said, the net effect of this tax reduction or this tax elimination is, there was a price disparity between legal and illegal operators, and consumers want to buy from legal operators. They know it's been tested, they know the quality control is there, but because the illegal operators who didn't pay the tax or anything, they could charge so much less, a lot of people were going to the illegal operators. So this eliminates that disparity. It also added, which a lot of people are really happy about, adds a lot of enforcement to get to sniff out the illegal operators. Because again, if you're legal and you're paying a lot of taxes and you see an illegal operator who is getting away with murder, basically, it's going to sniff that out and shut them down. There's a lot of social equity provisions. So if you have a social equity license, you are able to actually retain 20% of your excise taxes that you would normally have to pay into the state. You can take that 20% and reinvest it in your business, which is really, really nice. You're also eligible for a lot of different tax credits. There's one credit that you can get for $10,000. We can get into that later. And there's a bunch of other different tax credits depending on what type of vertical that you are in that you can be eligible for. So it's pretty exciting.
Yeah, it sounds super exciting. A lot of changes. So that is good, especially when, our operators are able to operate and be able to get those sales that they need. So
Sure.
Keep up and running. Awesome. Now, next, I want to talk about something that's often overlooked, personal property tax. Each county is different, but most jurisdictions have it.
Mm-hmm. Personal property tax. So this is just basically an additional tax that's assessed on your assets, your business assets, at the city, like you said, at the city or county level. This is a tax on your tangible personal property. So this is things that you may have purchased, machinery, equipment, computers, furniture, that you more than likely will see on your depreciation schedule of your tax return, basically. And a lot of people overlook this because they say personal property taxes. They don't get hung up on the word personal. This does not mean assets that you use personally. This is assets that are in your business that you're depreciating and you're using in your business. So, and the sort of life cycle of this is generally when you purchase something for your business, you purchase it and you pay sales tax, at the point of sale. Now, say you bought something out of state or it was shipped in and you didn't pay sales tax, you should also be paying the applicable use tax on that, but I'm not going to get into that. But then after that, you have to file an additional annual tax on your business personal property. So, and then most states, depending on where you are, most jurisdictions, they either authorize the city or the county to collect these taxes. And like I said, it's very easy. You basically look at your depreciation schedule on your tax return to see what they're looking to assess. So what I would recommend, and this is something that's often overlooked, and we've had a client who didn't even know that they were subject to it, and the county is coming back 3 years later, and they have been out of business for a year, and they're still assessing them for years that they are not even in business, which we're fighting now. So this is a really, really big deal. So I would check your assessor's office of your city or county and see if you are, have to report. Different jurisdictions even have different thresholds. So for example, Los Angeles County, you don't have to actually file a tax return unless your business assets, exceed $100,000. under that amount, you're still going to be assessed a minimal tax, but you don't actually have to file and itemize all of your assets at that point. So just really make sure to just double check that and make sure you're up to date, because it's one of those overlooked items.
Great recommendations. Now, another big potential red flag for the IRS is inaccurate 1099 records. Can you talk about the importance of keeping up to date with those 1099s?
Yeah, I like to just remind people every single year, if you pay anybody in your business that you're going to take a deduction on, you pay somebody, you pay trimmers, that they're not actual employees, and employees that subcontractors are not employees. Employees, you actually pay them, you withhold taxes, you send taxes into the government on a regular basis. I'm talking about subcontractors. They maybe come in seasonally, you pay them a check, they go on their merry way, maybe they'll come back months later. So it's very, very, very important that if you pay anybody, and like I said, you want to take a deduction for what you paid them, that you issue them a 1099. And it's really easy to just pay somebody in the heat of the moment and not have got their name, their address, their social security number, their EIN, whatever it is. So before you pay anybody anything, make sure that you get that information. You could even download and print just a stack of what's called W-9s. You don't have to file those with the IRS. Just keep it in your files. But it's so much easier because all your 1099s have to be issued to both your vendors, your subcontractors, and to the IRS by January 31st of every single year. And I guarantee you, every January, people are scrambling, trying to find that Jim Smith that worked for us for 3 weeks, and I don't have his name and address and social security number, and I need to issue him a 1099. On every single tax return, it doesn't matter if it's a Schedule C, Schedule E, if it's a corporation, an S Corp, whatever, there's two very, very, very important questions. They're on every tax return. The first question is, did you pay anybody that you would have to issue 1099s to, yes or no? And us as tax preparers, we ask this question to our clients, and we can look in their books and see who they paid. So we have to answer that accurately. So if that first question is answered yes, and the next question is, okay, if you answered yes, did you issue those 1099s? If that second answer is no, I can guarantee you that you will go under audit. So I just think it's really, really, really important. It costs a little bit more to issue the 1099s, but it's worth it, and it'll keep you out of the hot seat with the IRS.
Absolutely. Great advice on that. Now, moving on, I want to talk about the IRS $80 billion funding and what that means for cannabis operators and potential audits. What are tax experts anticipating?
Well, so this is still fairly new. It's called the Energy Bill, or the Inflation Reduction Act, and they keep combining it to say IRA. And I don't know if they're talking about individual retirement accounts or this Inflation Reduction Act. But there's a lot of new provisions in there. One that probably won't be applicable to most of our clients is that there's a new corporate minimum tax, which basically says that if you are a corporation who has been enjoying all these tax credits and bonus depreciation and all kinds of depreciation where effectively you were paying zero tax all these years, there's now a minimum tax that's going to be assessed to these corporations. And you're going to pay tax on what is called the book, or basically the financial statement income. And this just means that there's no credits involved. What is your actual income? So that's just a minimum tax that the IRS will be assessing. Now, like I said, it won't be applicable to most of our clients because you have to have a very, very, very high dollar amount to meet that. We hope it affects our clients someday, but probably right now it won't affect you yet. But the big provision that everybody is really, really nervous about is that the IRS added $80 billion, and that's 8 billion with a B, to the IRS to add auditors, to improve customer service, and to just fix their, ancient infrastructure. And don't worry about them adding auditors. But what that sort of means real world is that you have more of a likelihood to get audited if you are a cannabis provider. Again, though, if you're not doing anything wrong and you're playing by the rules, I have been in audits where there have been no change. But up to this point in time, because of all the budget cuts with the IRS all this time, it was more cost efficient for them to not go over, not go after very, very wealthy individuals or big corporations. It just took up too much manpower. So what they did is they focused on less wealthy individuals because it was easier to do, basically. So this bill provides a bunch of new auditors, but it comes with very specific instructions not to go after any individuals making less than $400,000 a year. Supposedly, they're not going to be targeted. But if history is any guide, the IRS has gone after cannabis because they're typically a financial windfall for the IRS. It's a really, really good return on investment, for lack of a better phrase. So, and what I mean by that, in a cannabis company audit, the average additional tax assessed per man audit hour was $950 per agent hour. On any other industry that's not cannabis, that amount goes down to $545. So in other words, if you were doing a cannabis audit compared to a non-cannabis audit, they came up with a lot more tax. And also, only 3% of cannabis audits came back with, no changes, compared to 21% of any other industries came back with no change. So what we would recommend is just keep your books tight, keep your SOPs in shape. Your records have to be evaluated all the time. And it sort of dovetails with what Jessica was saying with our new service line. We can just make sure that everything is buttoned up tight. So in the case of an audit, especially on a cannabis company, we can keep you, from the IRS having a windfall on your company.
Absolutely.
And there's other things in there. It extends electric car credits, which is actually pretty exciting. A lot of times people said, I missed out. If you wanted to maybe buy a Tesla or any other car that has already phased out, you may still want to buy the car, but you're not going to get a credit. Well, this reinstates new credits. You can get up to $7,500 if you buy a brand new car. And what that means by phasing out is they were giving credits to manufacturers. And once that manufacturer sold X amount of cars, that credit phased out. Well, that credit is just restarting again. And the energy bill, it adds a lot of provisions that we can drill some different areas for gas. Gas prices will go down, which eventually would help your business in the long run.
Great information. Thank you so much, Natalie. Such great input. We had a lot of people asking questions in this area, so we really appreciate just you taking the time to explain these breakdown questions. So thank you. Now, if you still have additional questions out there, viewers, be sure to stay tuned at the end of the presentation. We do have a Q&A session. We'll follow up with the presenters after the event. So just as a reminder, our contact information is in the description below if you'd like to set up a one-on-one appointment with our team. Now, we did have a question in the chat about the tax service line. We'll move that to the end because we'll definitely want to give Jessica a chance to answer that. But I don't want to miss out on talking to John because he is going to have some great information from the client service side. Clients are definitely our biggest asset, and we want to make sure that our clients are happy coming in and new clients know what to expect. So John, you spend the majority of your time customer facing. So I just want to walk through some questions. Hopefully we can clear up some confusion for some of our viewers by answering these questions below. The first question, we get this every day: when exactly are the extension deadlines to file for tax returns this year?
Thanks, Mandy. Appreciate you. The deadlines for returns will be December and S Corporation 5 and 1120 S to September 15th. Have a 1040 and you are attaching to that, and if it's 40 anyways, and C October 7th, 1040s and October 17th.
And John, we are still having a little bit of technical difficulties with your audio, and I'm sorry to all of our viewers. We did try to fix that. But if you are able to repeat those, maybe it will work again. Are you able to do that, please?
Hear me? Is this better?
It's a little bit, but it's breaking in and out.
September 15th, corporations are due, and 10 full tax returns, and you're due October 17th.
Jessica, is it okay if I flip it over to you to just make sure that our viewers know when those deadlines are? Sorry, John, you are still clipping out.
Yeah. So what John was saying is September 15th is the deadline for partnerships and S corporations. And October 15th would be the normal deadline for 1040, so individual tax returns and corporations. But that does fall on a weekend, so it's October 17th this year.
Awesome. Thank you, Jessica. And I'm hoping that maybe we can get John's audio fixed. I'm not sure, but I'm so sorry about that. So John, if you are able to answer, how are you handling the extension deadlines for tax returns? What are some key things to note that would help the overall experience for both sides?
Yeah, thanks, Mandy. Constant reminders. A few months back, we didn't, not only our team to have enough time to focus on, so we came up with an idea, the information prior internally August 15th, we're able to potentially, if we have all their documents, it's kind of helping both sides out by reminding them, usually calling, texting, or email weekly basis, just as friendly they can remember to provide for our internal deadline. That way we can potentially file on time for them and really focus and pay attention to.
John, yeah, I'm so sorry your audio is still breaking out. What I'm gonna do is move over to some of the questions that we have, if that's okay. And then if we can get that fixed, we can move back over to you. So I apologize. We did, like I said, we tried to get that fixed, but just not something we can fix right now. So I do want to move to one of the questions that we received before the Q&A. And this could go to Natalie or Jessica, but currently we have our businesses set up, and this came from a viewer. Currently we have our businesses set up as an LLC, but after speaking with a tax attorney, she suggested we set up a C Corp as an umbrella over the LLCs. I was just wondering how other companies are structuring their businesses to avoid paying high taxes. Natalie, do you have an answer for that?
Sure. This is actually a pretty good technique. So right now in the 2018 tax plan, Trump gave business owners, corporations, a gift. And the current tax rate, flat tax rate, no matter if you make $1 billion a year or $1 a year, the tax rate is 15% if you are a corporation, not a pass-through, but a corporation. So one thing you can do is you can have what's called a holding company, set up a holding company, and that holding company's only function is basically managing any LLCs underneath that holding company. What I mean by that is you can have an LLC who's the actual operating entity for whatever it is that you do. You can have another LLC that maybe could hold the assets. Maybe you have a lot of machinery or a lot of tools or something that you could maybe the operating company can rent back and forth from, or maybe you could have another LLC that actually holds the real estate where you're operating out of, or the land where you harvest. And these LLCs underneath sort of flow up into the corporation. And depending on how many people are involved in the LLCs, if there's just one owner of each LLC, that makes it a single owner, single member LLC. And all of that activity, that separate activity, is going to be reported, going to flow up into that holding company tax return anyways. Now, it does take a lot of extra footwork to sort of keep all of your LLC, activities separate, but You flow it up into the corporation, and whatever the net result is taxed at 15% flat tax.
Awesome. Thank you so much. Next question is for Jessica. Guidance for dispensaries and other verticals for maximizing allocation of indirect costs, identifying direct costs like 280E inventory.
Yeah, so the biggest, I guess the biggest guidance I have is document everything. So again, as we've been talking a lot about audits, the best thing you can do is keep your books on a regular basis. So ideally, you're going to want to be making sure you're reconciling on a monthly basis, but no less than quarterly. You want to make sure that you keep all of your supporting documents as well. So a lot of times when you're moving indirect costs into cost of goods sold as direct costs, there's allocations involved. So maybe it's a square footage allocation, maybe it's a payroll allocation. It really depends on the expense type and your current operational structure. But if you're doing allocations based on that, again, the best way to survive an audit is to maintain and save all of the supporting document that supports your allocation method and percentage that you're moving from indirect into direct costs. So, again, the biggest guidance I have is just document everything, hold on to it longer than a year. So don't just hold on to it for a year and then throw it out. The IRS technically has 3 years to audit you unless they could prove fraud, intentional fraud, then they have a little bit longer. I always tell people, rather be safe than sorry, right? Probably hold on to things for 6 or 7 years just to be safe. And that way you don't have to sweat or worry if the IRS comes to you for an audit, especially with all these new agents, because you have all of your support documenting that.
Absolutely. Yeah, definitely. It's safe just to keep everything until you know that you're clear. Okay, we have John back. And John, real quick, I just want to see if your audio is working. So if you could maybe just run through those tax deadlines one more time. We can't repeat them enough, so it's safe to say them again. But I'd love to just see if we have your audio back.
Yeah, hope better. The deadlines to file your coming up, and it's the first one, and that will be for multi and S corporations. So that's for 1120 S's, and then the other 17th, then that's for your individual corporations. So that's a 1040 or a.
So no, it didn't fix. I'm so sorry, but it was worth a shot. We'll run back through we'll go back to the other questions here. I have another one for Natalie. What should people be careful about when you have a cannabis and a non-cannabis entity? And I think that one can actually go, maybe we can have a discussion with Natalie and Jessica on that one, but what should they be careful for on each side?
Paperwork, bookkeeping, making sure everything stays separate. And what I mean by that is, so as you know, a non-cannabis entity can deduct everything that's ordinary and necessary for your business. You can deduct. Cannabis, you're limited by that 280E. And so there's a lot of things that are ordinary and necessary that are not necessarily deductible, right? So if you have these two entities, you really just need to make sure that whatever expense, you have it classed out correctly, or you have it separated, so you know these are deductible for this particular non-cannabis entity, and keeping track of all of your expenses for your cannabis entity. Do you have anything to add, Jessica?
Yeah, so I just completely agree. Again, I feel like I've just been repeating myself a lot about the importance of documentation and keeping good records, but it's very true. That's one of the best things that you can do, and especially with a cannabis and a non-cannabis entity, because if they're related, or especially if you have them where maybe one's flowing up to another, or if you combine them all on one tax return, you can open yourself up to more investigation on the non-cannabis entity if it's found that it's related to a cannabis entity. The biggest time I see that is if they're on the same tax return. So what Natalie was mentioning earlier about how sometimes we have them flowing through onto the same tax return. So essentially it's all reported together. Well, if the cannabis entity gets audited and your non-cannabis is on that same return, they're going to be looking at the numbers and books for both. So again, just keeping very diligent records. And like Natalie was saying, making sure it's very easy to distinguish between which expenses are directly related to the cannabis entity versus the non-cannabis entity. So that way later it can't be determined that you are commingling funds and assets, and that there was a very distinct line drawn between the two entities.
Absolutely. Thank you so much for that, both Natalie and Jessica. Now we've gone through the questions that that were turned in before our live event. We did have one here in the chat about the new tax service line. And the question is, what do these strategies consist of? Do you have any examples?
I mean, it really varies depending on the person, the entity, how it's structured. Like, is it a flow through entity? Is it just a corporation? But I mean, one solid example is one of the things that we talked about earlier is that pass through entity credit. So if you have a partnership or an S Corp and you're in a state that has a pass through entity tax credit, that is definitely one thing that we would be looking at. For other businesses, especially cannabis related businesses, we're just going to be looking at making sure we're maximizing the 280E allocations. And if there's anything that we can do before the end of the year, like a common one we see is if somebody needs a new piece of equipment, they're like, should I buy it this year? Should I wait till next year? I really could wait if it's not going to benefit me, but we can help with the planning and help you determine what your tax savings would be if you bought that piece of equipment before the end of the year.
Awesome. Thank you so much for that. And it looks like we're good on questions in the chat. It looks like we covered everything. So I want to thank the viewers and the panelists for joining today, spending your lunch hour with us. We hope you enjoyed the event and the tax information that we covered today. Now, if there are any questions that we didn't get to, maybe we missed in the chat, we're sorry about that. We'll definitely reach out and be able to send those answers out in the future. But to learn more about the presenters and the services we offer, make sure to check out the information in the description of the YouTube video and to contact us directly. We want to thank everyone, and I hope everyone has a great day. We'll see you soon. But thank you, Natalie, Jessica, and John. We appreciate your time, and we hope you have a great day. Thank you.
Thank you so much.
Thank you.